Once again, good evening, everyone. Last week, we discussed about the fundamentals of any company that we are going to take interest for trading, investing, or any study purpose. So for that, first of all, we required that company to be fundamentally good enough for any consideration. Now, fundamentally good enough, what does it mean? So we discussed about the company's sales growth, sales management quality, lot of points we discussed, right? These points, if company is holding good, means company is fundamentally sound. It's like business. So company which has already holds good quality in terms of business growth, market experts knows about that growth story, and they start giving the recommendations and future expectations. Management also, after every quarterly results, gives their commentary how the business is going to happen in coming quarters. So that way, you will see constant commentary will come on the business every 3 months or so. Our annual reports will come. So those are the primary source to study any business. That's the company's quarterly results and annual reports. Company publishes its view on further down the years what they are going to do, like some new factory they are setting up, some new territory, like new countries they are exploring to export. They are maybe doing the tie-up with any foreign companies. So these kind of information they will give on time to time on the website, that is NSC website, they have to declare. And in their company report also, you will study their management commentary, like CEO or MD. They will tell you about the future, what they're, because public limited companies are answerable to their shareholders. So every quarterly, this provision by the NSC that they have to declare the result and to take the question answer session by the public who are their shareholders. Even if somebody is not shareholder, they can participate and ask the questions. So every quarterly result, you will see the question answers by the management and some presentation, yearly view. So by that, studying that closely, you can know how the business is growing or the management having the vision of the future. So that's the primary source. But now there are many websites which will pull the data and keep everything available for each company. Like you have to go to for any particular company on their website or NSC website. But there are some good websites available which are keeping all the data together. And you can compare also X company with a Y company and such. Like it will be easy to compare from the sector perspective, market size perspective. So there are enough data available, enough websites available who can give you very decent way. Yeah. So sorry. One such company, one such website I will show you. It's a Telegram trendline.com. So any particular business where we will be interested to study, we would know here. For example, I will take any well-known name, say TCS. And first of all, I will explain all the points. Then I will start taking examples from you guys. So what are the things we will be looking for any company which is we are interested to know? We will go to, this is an overview, front page is overview. Then FNO data you ignore, financial, news, any reports. Reports mean expert will give some kind of reports like this. They will write out about the business, what's happening, their target, by are they giving upside target, downside target. So you will have a reports also. Technical, that what we are going to study. There are some technical parameters. Based on that, website will directly give you whether this stock is bullish or not. It will not give you any target, but it will give you various parameters, what are the scores. So if you know what any particular scores mean, you will be able to read this data in favor of your trade for entry, exit, or hold perspective. Then there will be delivery. Delivery is like every day stocks is being traded, how much quantity is being delivered, and shareholding patterns. So let's start with the shareholding pattern. So what is shareholding pattern? Any particular share is bought by various players, as we discussed during previous our sessions, that it could be LIC, mutual fund, we retailers, some corporate bodies, and foreign investors. So there, the company shareholding pattern will tell you a lot of picture about who all are interested in this particular company. Like TCS, this wheel is very clear. Promoter are holding 72%, mutual funds are holding 3%, FIIs are holding 15%, public is holding only 4%. So retailers like us are holding only 4%. So who are the strongest in TCS? I believe promoters are very strong. You will see every year they are buying back from the market. So they can literally hold the share prices because they are cash rich and they are doing well. They have a cash power. So suddenly, if market crashes, and for you can say not good regions, and TCS is still have a belief on their businesses and performance, what they can do when the prices will be lower, they can buy back from the market, right? So this kind of power with the money and the way companies going ahead, they can hold certain prices if it's an unreasonable drop in the prices because of any particular region. So strong management is good for public shareholders also, because they will also not like their company's valuation to go down. So a strong management in terms of shareholding, their the cash rich they are in the previous history, whether they are providing, uh, they have done the buybacks. So these kind of information will give you some surety about the share pricing in the future. Plus, these others are corporate bodies and etc. So you see here the in what information we are usually getting. Promoter holding 72%, they are major share. They are the major. Uh, they are holding major chunk of shareholding. So that's a good sign. So mostly you study, I'll say thumb rule, try to consider companies only which are holding 50% or more by the promoters. So first of all, promoters will hold most portion of the share. And then there should be some presence of mutual funds and FIIs. Why I'm saying like this? Whenever there is some mutual fund is buying, they have certain process, good or bad. They have considered few things, then only they have gone into buying those stocks. So this kind of some filter will keep you, you can say, it will give you some advantage that this business is well studied by some market expert. So that will give you one surety, sort of surety. Nothing is guaranteed. They can also make a mistake, but this kind of shareholding holded by market experts are good. And then there are some individual uh, experts, you can say, sorry, expert, uh, market investors are there who are very rich, and they are investing also in these companies based on their individual study. When you'll go into detail, you'll find certain names where, like when we are going here, we can see that some trusts are holding, but corporate bodies are there. In there will be many stocks where individual, you can say, people like Dolly Khanna and Monish Pabrai, or these stars will be holding those shares. So any questions on the shareholding pattern? Anyone? So these kind of is share. One more thing which we should monitor: how much percentage of share are pledged. Pledged means what? This is like a property. Like you put your uh, land in the bank. You put the paper of your land in the bank and take the loan. Suppose you default to give back your loan, what will happen? Your land can be taken away legally by the banks. So same way, these promoters, when they required some money, this is their property, right? Shareholding is what their property. They uh, all company they converted into number of shares, and they are holding 72%. So for any particular requirement, they can put these papers in pledge. But the problem happens when pledging is very high, and somehow uh, suppose this promoter not able to withdraw its pledge or not able to pay for his pledge, what will happen? Bank will, or anyone who is holding those pledged share, they can take hold of that company. Now it's not an issue. New promoter will come, but the issue is they are not expert to run the company. Suppose a bank take over some company because promoter had not paid against their pledged share. What will happen? They will not going to run the company, right? So they will sell in the open market or any particular person. So demand, that depends on the demand, whether the person who is going to buy will going to buy on the premium. It's a very unlikely that somebody buy the pledged share at a premium of the market. So the share prices may crash. So especially we have to take care that promoter pledging, there should not be large chunk of pledging. Maybe he can have, you can say 10-15% of their shareholding pledged, but not more than, you can say not more than anything more than 30% pledging. You should avoid that company. Yes, yes, Dr. Saab, any questions, please?
Sir,
Yeah.
good evening.
Yeah, good evening.
This trendy line website, is it enough to cover all the fundamental aspects or other
Yes,
aspects? This
there are
website?
two more. You can go to Webull, you can go to Money Control, and you will have enough information. And you can visit NSC. NSC will have all the information that retail shareholders like us require. And most importantly, you visit the company website. There you will
Okay.
have a lot of information about all the products, their marketing, any new initiative. You can go on their announcement section, right? When they are doing some kind of new product or new businesses, what they are doing, they are publishing it, right, on the news section. So there you can, if you are interested in putting money in any particular company, you should visit 5 minutes on their website, and you will have a lot of ideas about there. You can read their last year presentations, some conference calls. Those will help you to get the idea about that particular business.
Okay. These quarterly results, are they published well in advance in their company websites before that comes in news or before it is publicized?
No. It will come on the set date, like June quarter has just ended, right? Now they have, every company has to post their June quarter results before next quarter starts. So generally by the September end, you will see all the results will be published.
Because what I observed before the positive or good results of the companies published or notified or published, informed, before that only there will be rise of the price. By the time it is announced, almost it has reached to upper circuit or it has gone up.
Yeah, I understand your question. See, what is happening, it's not that company is doing business in a dark. Whenever they are doing a business, they are doing in the market, right? So suppose TCS is doing good, and TCS result is say on, suppose in September or August. So what will happen in July? Suppose Infosys result comes. Now Infosys is their competitor. If Infosys is doing good, there are investors that they assume if a competitor, biggest two competitors, one is doing good, one result is good, automatically they will take the interest in another company also. Plus, there are global competition right now. So somebody posting a result just after July quarter, say on 7th July itself, some global competitor in USA who is doing business in USA and Europe, they posted a good result. So now world is connected very globally. So any metal company who is a big company in USA or Canada, if they are posting high, very good margins and results in the USA and Canada, immediately Indian metal companies, you will see some sharp rise on their share prices on very next day. So they assume, and that is where a surprise, when there will be any surprise in the result, say public has assumed based on the some external positions or a news, they have assumed that this result could be, this is the possibility. Now there can be surprise against that possibility. If result is better than this, the expectation everyone having, then the prices will go upside on the result day. Because people have assumed that they will post a 100 crore profit and they posted 120 crore profit. Because of lot of information already available in the market, like raw material prices are available in the market. People, there are experts, thousands and thousands information already available. Everyday metal prices are available, right? So they assume that Maruti has made every, say, 1,40,000 car in this quarter. Why? Because every month they are publishing the sales numbers of the cars. So automatically they know, before company posts the result, they know last 3 months how many cars they have sold. Now they know the car sold, they know the history about their margins. Okay, they know about the margins and they know about the raw material prices. So somebody is expert enough can calculate how much is profit Maruti is going to push. And based on that, if they see that profit margins is under pressure because of raw material prices. Yeah, please mute somebody. Mahesh, I guess. Yeah. 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 So what is happening? There will be surprises on positive side or negative side. So based on that, the result day reaction could be different than what you are thinking as a retail investors. Now let's come back to that quarterly part, which is more interesting here. Anybody on anything on shareholding pattern? That's the most important thing. Always go to check who is holding the shares, and then you come back and check all the fundamentals and other things. Now, how to start looking? This is a quarterly result. I take down financial and gone to quarterly results. Before quarterly results, I would like to have a quick view on annual results. Annual results, 4 quarters will become one annual result. Let's say start looking from 2013 numbers. What are the things we have to see? Total revenue annual in crores. So this company TCS was posting earning 64,000 crore. That become 83,000. Huge jump within 1 year. Then 83 to 97, 111, 122, 26. This was a phase little less growth than the previous years. Then 26 to 50. Very good jump here. 50 to 61, again growth has slowed down. 61 to 61 again slow down. 67 to 74 again little moderate. So initially the growth was very quick, like 64 to 84. It's like 30% growth in the revenue. 83 to 97 is also a huge chunk, more than 15%. So when company size going big, we are seeing that growth is not as fast as in the previous years. That's just one impression, but it's still a yearly basis. They are growing with a almost like you can say close to double digit. Year on year, they are growing. Okay, so if revenue is going double digit, means company is growing double digit, means your share has a possibility to grow in a double digit. Now all the banks, FDs, and other things are giving you 6.7% return. So against that, a company which is going in a double digit has some assurance that over the period your stock prices will grow in a better way. Now, it's not a direct correlation, but you will just, it's a logical thing you need to understand. That if company is growing in a double digit, what does it mean? Means their valuation is growing in a double digit. Sales is what? Revenue is what? Profit is. These all are increasing the valuation of the company. A company which was having a 2013 64,000 crore sales is now having a 1,74,000 crore sales. Means within 7-8 years, they have been more than double. Now this is a revenue. What is the operating expenses? all those expenses of employee expenses, raw material, any purchase, any office expenses, they are paying rents, they are paying electricity bill, internet bill, all those expenses together. This is the expense. So they have earning and expense. So what is the remaining items is operating profit. So see here, uh, sales have been more than double, but the profit have been almost tripled, more than 2.5 times. So it's obvious that your expense will not grow in the same fashion as your revenue most of the time. So your profits will grow better than your revenue if your profit margin is intact. So they are doing business on a very healthy profit margin, 28%, sometimes 30%. But mostly we are saying 28% on average, 26 to 28% they are earning. So it's a very good thing. Like if you are earning 100 rupees and 27, 28 rupees is your saving. So you can say the business is working in a not in a very competitive way. What does mean competitive way? If somebody is earning or growing with a very cheap margin, their growth might not be sustainable. Here, they have a healthy margin, means they are growing also and they are maintaining their profit margins also. Consider it like this way: if somebody opens a sweet shop and it's a single sweet shop in the whole area, then that might command a premium. Consider it as a cake shop or something. So somebody having a single cake shop in a town, he can command a premium for making a cake. Like in somebody, if 2, 3 more competitors will open in the particular area, he has to to have a same revenue or same number of orders, he has to reduce prices, because competitor, when the competitor will come, what he will do, he will provide some extra features. In place of 1 kg cake, he will provide 1.2 kg cake. He will make some graphics. There's a lot of activities competitor can do to bring, take your business uh, from from you. He will like to have more business, right? So there will be some competition. So they are already having a competition from Indian companies, from worldwide companies, and still if they are managing 28% margin, means they are running their business very professionally and in a very, they will have something on premium. It's all about some premium, right? They are commanding. Otherwise, there will be companies, small companies, we will take the orders in a 10% margin, 12% margin. There are many businesses like we've seen that automobiles which are running on 10%, 8% margin. So why they are putting so much, so many thousand crores into business where margin is only 10%? They can also do the IT business, but it's not easy, right? They have expertise. They become expert in 30, 40 years of running the business. So somebody, someone new cannot come challenging him and take their businesses. So that way, it is giving you an idea that margin is very important factor. So somebody running a good margin business is always a thumbs up. Now next, total expenses annual crore. There, here you'll see here, interest is there. What is the interest? So like they might have taken some loan, some working capital loan. All businesses required because they are doing the transaction. So for hundreds crores, and this is here we are talking about 1,000 crores. So when they are doing transactions, they might have taking some kind of loan, even if they are rich in cash. There will be many companies which will be taking high capital debt, but there might be some which are running totally debt free. So debt free company will be very good because they will be they are sustaining in the market without any external debt. Here, company is operating at 1,67,000 crore, and this is very, very less. So all other expenses like depreciation. What is depreciation? when they are holding any office and they bought any chair, say any decks, any laptop, it has a life. So whenever they are buying, they know that this will expire in 4 year, 5 year, and they have to buy another if they have to run the business. So whenever they are buying any particular item, be it a chair, light bulb, anything, they will immediately start counting that his life is say 4 year of laptop. So in 4 year, they will keep some money to for that particular laptop to replace after 4 years. That is a depreciation. Somebody has bought, say, running a manufacturing unit, and they are using, say, lathe machine. So that lathe machine will have a breakdowns. So they will keep, and its life, say 9 year, 10 year, that life will over. And in 10 year, they have to replace it if they have to run the business. So, so say that machine is for 1 lakh rupees. So what they will do, they will cut 10,000 rupees every year for 10 years, so that after 10 years, when this machine will be over, their life will be over, warranty will be over of that machine from source supplier, they will buy a new one. So that's called the depreciation. So interest, depreciation, taxes, because there will be taxes also, right? Government will take the taxes. So everything put together will become, they will reduce everything from their profit before tax, and that will come on net profit. So this is cut to cut profit. Like you are earning, you are getting salary, you are on your salary, you are giving tax, right? And before that, there are some schemes from the government, like you taken any loan, or you have like 80, some PPFs are there, some life LICs are there. You can reduce, and then you will pay the tax. And the net income, there is one CTC, and then there is a net income. So this is the final profit. And this profit is against how many shares? Suppose they have only, this is 32,000 crore 430 32,430 crore rupees profit, annual profit. Say they have a 1 crore share. So each share have a how many earning? 32,400. Each share have a 32,400 earning. But if they are not having 1 crore share, you will get to know how much is there. Now it will comes the some points which you have to remember. I already forwarded, but I will explain that. That's the earning per share. So what is the earning per share? The one I talked, that if they have a 1 crore share, each share has a earning of 32,430 crore. But they are not having 1 crore share. We will get to know by an SAF site how many they have. But easily we can calculate here. How we can calculate? This is the total profit, and for each share, earning per share, how much they are earning? 86 rupees. So can you know the number of shares? Just divide it. Divide this 32,430 crore by this value, and you will know how many number of shares are already in the market. So actually you do not want to know how many shares are there. Just you should know for each share they are earning 86 rupees. And this is an important number, because you will give the valuation based on their earning, right? TCS is earning 86 rupees for one share. So how much you will pay for them? If any business you want to buy, any land, any commercial shop, say rented shop, and you know you're earning, so you can pay, right? You know that if I'll get 1 lakh rupees earning from the rent on these commercial properties, you can invest, like you can invest, say, I can invest 40 lakh rupees for 1 lakh rupees earning per year, because my commercial property will also increase over the year. And I will have a 1 lakh rupees, means 12 lakh rupees every, so per month, 1 lakh rupees per month, so 12 lakh rupees per year. So within 4 years, my investment will return. This is how you calculate, right? So same way, share price also you calculate that they are earning 86 rupees. How much you are ready to pay for this earning? When you buy one share, this is what you are getting from this company. Now, this company will not give you 86 rupees. Every year you are not giving your share back to them and take the 86 rupees. What you are actually doing, out of this 86 rupees, company will give you some dividend, maybe 3, 4, 5 rupees dividend. And because they are earning this money, 32,000 crore, where it is going? It is going back into the business. That's why they are growing, right? That's why they are going. This is going back to the business. So where they are investing? They are investing into some new technologies, new research, new markets, some sales, you can say marketing campaigns, hiring new people, expanding their business, expanding their territories. Maybe they are into one particular business and they are entering into one new segment of business. Somebody making a tire, say for cars and motorcycles, and they will start making a tire for tractors or any bigger vehicles. Or maybe they start a business exporting in particular, say Australia, they are not exporting it. So that way they required some infrastructure, right? Somebody wants to export in Australia, what they require? They will require some dealership chain there, who will buy, who will take. There will be some uh, legal things to comply for that particular country. They might require some investment. They might require a small production line. Something will be requirement, right? For that, they required money. So these earnings will help them to expand. So how it helped? It will help to grow your share prices, because company size will increase. Then per share values will start increasing over the years. And that is how you will get the benefit. Now earning per share, once again, I will explain. Suppose a company is getting a profit of 1 lakh rupees and they have total number of share 1 lakh. Means for each share, how much is earning? 1 rupees. Say 1 lakh rupees, there a profit and 10,000 share is in the market. So for each share, this is a 10 rupees profit. So earning per share is per share, how much is the earning? So total earning divided by number of shares. That will be earning per share. Simple thing. Now there is another term, PE, price to earning ratio. What is the price to earning ratio? Now they are earning 86 rupees, 87 rupees, but the share price is 3,309. So this is the share price everybody is trading. So divide this share price with the earning per share, that is 86. Say consider 100 for a easy division. For 3,300 you will divide. So it will become 33. So say 36, 37 will come around. So that will become price to earning ratio. Means this is the price and that is the earning. So price to earning ratio, this is very important to compare two companies. How you will compare? Because each company will have a different size, different earning, different number of shares in the market. So how to compare it? So it's like to compare, you can say anything in the liter. So what you do, you have set the parameters to compare. So this P ratio is a parameter to compare two different companies based on that, because different sizes will come. Any questions on price to earning ratio? Please ask. These are very simple things. If it required, I will explain once again.
Yes, Darpan, price to earning ratio, there is like any criteria, like it should be more than, or to check, like how we know that it is good price to, matlab ye acha price to ratio, earning ratio.
Yeah. I will tell. So once again, I will explain price to earning ratio, PE, price to earning ratio. What is the PE? What is the current share price? Current market, CMP, we'll say current market price. What is the current market price? So here in this case, it is 3,300 for TCS. Okay. And divided by what is the earning per share? Earning, what is this earning per share? In our case, 86. It is 86 rupees. So when you will divide 3,300 to 86 rupees, you will get the price to earning ratio. This is this is important as you have to, when compare two different companies, you will get to know which one is available cheaper. So the company which is having a P ratio of more, that is not cheaper, right? For each rupees of earning, you have suppose 100 P ratio, means your price is already 100x against your earning. Is it clear? Say P ratio of 50, what does it represent? For each rupees of earning, you are already getting 50 rupees from the market. You are at 50 times costly than your earning. Somebody is available at 20p. What does it mean? It means it is available 20 times the earning. So lower P is good, means it's cheap, but something will not be cheap because everything market is seeing everything. Earning the value you are reading on the website, or every investors can see also. So why it is getting only 23p and why he is getting 35p? That is the question Mahesh is asking. Which one I considered better? So price to earning ratio as a value. Suppose we want to buy a company. Suppose we are rich enough to buy any particular company. We would like to buy at low P or high P. For a company which is giving me 100 rupees for one share. That's earning per share. What is the ideal condition I should buy to that business?
So at lower P.
Lower P. Suppose I can buy in 100 rupees, means within 1 year my investment will come back. If somehow I can buy that company in, suppose in TCS, what is the 1 year profit? 32,000 crore. And if I can buy TCS in 32,000 crore rupees, I have suppose enough money to buy TCS in 32,000 crore. What does it mean? I will invest 32,000 crore and within 1 year, all money will come back to me and I have a free business to run. And every year I will earn 32,000 crore. It's not easy. Somebody, if I'll have 32,000 crore, somebody will come with the 64,000 crore and say, I will buy TCS. Within 2 years, my money will come back to me. Somebody more richer will come at 10,000 crore. Within 3 years, my money will come back. I'm more than happy and I will be holding TCS as a company. So that way, right now, market